Have you ever entered a trade, watched price move just enough to stop you out, only for it to reverse and move strongly in your original direction? That wasn't bad luck. That wasn't manipulation against you. What you witnessed is called a liquidity grab, and it's not the market hunting you. It's simply how price moves in any freely traded market. Liquidity grabs are one of the most common reasons traders lose money. You've heard many traders talk about it, but it's proving a little difficult to understand its concept and how it impacts your trading. But in this video, you'll learn what liquidity grabs are, why they happen, where they occur most often, and how you can avoid being caught on the wrong side of them. By the end of this video, you'll never look at stop losses, highs, or lows the same way again. Let's begin. Before we talk about liquidity grabs, you need to understand liquidity itself. Liquidity is the ability for orders to be filled in the market. In simpler terms, it is how easy it is to buy or sell something right now. Imagine a marketplace. If many people are buying and selling, you can buy or sell instantly. That's high liquidity. If nobody is there, you can't trade. That's no liquidity. In Forex, liquidity means there are enough buyers and sellers in the market. Now, every buy order needs a sell order on the other side, and vice versa because trading is a swap. You are not buying from the chart. You are buying from another person or institution. So the simple rule is, every buy needs a sell, and every sell needs a buy. Stop losses, pending orders, breakout entries, all of these create liquidity. And liquidity naturally collects around obvious price levels where many traders make similar decisions. Examples include previous highs and lows, equal highs or equal lows, range boundaries, popular support and resistance levels. These areas attract a high concentration of orders, regardless of who placed them: retail traders, institutions, algorithms, or funds. A liquidity grab occurs when price moves into one of these areas with clustered orders, triggers them, and then moves away from that level. Think of price like a vacuum cleaner. It moves toward dust, which are orders. Once the dust is gone, it moves away. Liquidity equals dust. Liquidity grab equals vacuum pass. To some traders, it looks like a failed breakout or a false reversal, but in reality, it's simply price accessing available liquidity so larger positions can be filled and the market can continue moving. This is a market mechanic, not manipulation. Liquidity grabs happen for a few important reasons. First, markets need efficient order matching. Large orders require many opposing orders to be filled. Second, traders tend to cluster their orders in similar places. This creates predictable pools of liquidity. Third, once liquidity is absorbed, price often moves more cleanly because fewer opposing orders remain. This is why strong moves often come after a liquidity grab, not before it. Liquidity grabs most often happen in very obvious areas. 1. Equal highs and equal lows. Stops cluster here because traders expect reversals or breakouts. 2. Previous session highs and lows. Day traders and algorithms pay close attention to these levels. 3. Range highs and lows. False breakouts are common before price commits to a direction. 4. Major market openings. Increased volume during London and New York sessions makes liquidity access easier. Being aware of these areas helps you anticipate potential traps. Most traders get caught for the same reasons. They enter trades immediately on breakouts, place stop losses at obvious levels, and trade without confirmation. When price briefly breaks a level and reverses, it feels like a trap, but it's actually a result of poor timing, not bad direction. The issue is usually when traders enter, not what they trade. Here are practical ways to protect yourself. 1. Avoid instant breakout entries. Wait for confirmation after price reaches key levels. 2. Look for structure shifts. After a sweep of highs or lows, wait for price to show acceptance or rejection. 3. Use higher time frame context. Liquidity taken against the larger trend often leads to continuation. 4. Combine levels with price action. Don't rely on one signal. Use structure, reaction, and context together. 5. Place stop losses thoughtfully. Avoid placing stops directly at obvious highs or lows whenever possible. Instead of fearing liquidity grabs, you can learn to wait for them. When price takes liquidity and then shows confirmation, it often offers clearer, higher quality trade setups. Understanding this concept helps you trade with patience, not emotion. Liquidity grabs are not tricks or manipulation. They're a natural part of how markets function when many participants trade around the same levels. Once you understand where liquidity sits and how price reacts to it, you stop chasing moves and start waiting for better opportunities. If this video helped you, like and subscribe for more trading education and comment below what topic you want covered next. Trade with awareness. I'll see you in the next one.